Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm excited today to be here with Bill Paton from Alloya Federal Credit Union. Bill, how are you today?
Mark, for having me.
Interesting times. And hey, I had you on the podcast one other time. I know we talked about capital markets back then, and we're going to talk about some nuances related to that. But I saw on LinkedIn you were making reference to a loan participation program that had just passed $3 billion in transactions that Alloy has. And I thought it would be good to talk about that program and how it's been working for Alloy and how it's been working for your client credit unions.
And I appreciate you reaching out. Yeah, we recently, last month, crossed the $3 billion mark in terms of transactions on our platform. We've gone over $4 billion in total for the program. And it's a really interesting kind of history of what happened there. And I think that's the most important part of the entire program. But just real quick, probably like 8 years ago, Alloya used to purchase corporate federal credit union were able to purchase loan participants. It was called Part 5 authority that they had to purchase participation from credit unions. That was taken away during the crisis, but we still had a lot of credit unions that had the need to sell participation. So we had gotten a phone call from a credit union to say, hey, we know you have a large network of credit unions that own you. Can you help us? And so we just brokered a deal. And then that became another deal. And then that became a third deal. And I remember going into my boss at the time and saying, hey, I think we have something here. Do you mind if I kind of mess around with it a little bit? And he said, sure, just don't do anything stupid.
Oh, it's good advice.
Which is great career advice. And while I can't say I did do anything stupid, I do think that that certainly outweighed the risk in that. And we did about $1 billion. But during that time frame, our CEO, Todd Adams, said, hey, there's really something here. And I think we can do more than just brokering deals. And that's needed. And there are a lot of people that do that. And they're really good at that. And he really wanted to create a end-to-end solution created by the credit union industry. And so that's what we did. And they invested a lot of time, a lot of resources. So credit to him, our senior team, and our board for doing so. But it's really the first end-to-end loan participation solution created by the credit industry. There are others, and they're very good too, I admit, but this is the first created by the industry. And so, so we've done, like I said, about $1 billion before that, $3 billion now and growing. We've got over 500, I think maybe even closer to 600 credit unions on this system right now. There's new ones coming every single day, and it's great. And it plays really well into the corporate hemisphere, I think is the right words. Corporates, maybe you know better than I do, so let me ask you this, because I don't think anybody really knows. Corporates, we believe, were created in the late 60s or early 70s. We don't know when.
That sounds right. I might have to, I'd have to go back. The best way to check that might be NCUA's annual reports, which are on PDFs. They used to be very well organized on NCUA's website. I was messing around looking for a year the other day and couldn't find it, but that's probably the best way to check. If you guys couldn't find it, I would say that there's probably an annual report that references it.
Stating that'll be a fun research project. But corporates are created really to do two things, right? They're created to provide liquidity for credit unions and to help them access the Fed when the banks effectively, combine together and get them out of the banking space. And so we continue to do that today, just in different ways. And loan participation is a perfect example of being able to provide liquidity when they need without having to draw on a line of credit. And also, additionally, invest great assets in system assets when they have the additional capital and the additional liquidity. So it's really a credit union. It's really a credit union solution to those problems. And we love it, and we're heavily invested in it, and we'll continue to be. So yeah, we're super proud of it, and really what it's done for our company and for the industry.
Couple things I wrote down here as you're chatting. So 600 credit unions on the system. You've got the portal. I think in the old days, maybe when you were helping be a matchmaker, that might have been more of a hard copy type setup. And now you've got this portal and so 600 credit unions on it. I'm assuming that means you have some that are on there to buy, some that are on there to sell. Any kind of a mix you could relate relative to that, and had any thoughts on the portal and how that all works and that.
Using the term matchmaker, great term. That's really what we did prior, and we still do that. So of the 600 credit unions today, it's 4 to 1, 4.5 to 1 buyers to sellers. But it's, I think a lot of people, when they think about this, they say this participations have historically been, and this is a fun thing to go and look at the numbers. Historically, it's been like a larger credit union type of play over the last 20 years. This is not a new solution. It's been around for a very long time. But what's been really interesting is to see how the smaller credit unions have started to utilize it, right? And so we have a credit union that is $14 or $15 million that sells some mortgages to us because they serve a very specific setting. And those say a couple people need mortgages, but it's only $15 million. So you throw a couple mortgages on that, kind of really chunks up the balance sheet. And then we have 20, $30 billion credit unions that sell through us on a regular basis. And it's great because that system is agnostic to size and it helps however, right? And so there is a match or marketplace side of things. And there is a system was really built with the NCUA guidelines, right? The requirements for participations in line. So if you're a buyer, when you go through our process, you don't even know that you're going through the process, but you can't actually complete the deal without doing all the requirements that the NCUA says you have to do. You got to look at, the underwriter, the originating credit union's due diligence package. You got to look at the loans. You got to make notes, whatever it is. You got to have an agreement in place. And we have one single agreement. It's created by credit unions. We locked 12 credit unions, 6 buyers and 6 sellers in a room. I'm not joking about that. We locked them in a room and said, hey, you guys got to come up with a relative framework. You got to figure out the rest of it. And they did. And it's partial to either side. Alloya is a party to it as well. So as a credit ourselves, as depository ourselves, we have a balance sheet. And so we will help facilitate the flow. So today, when credit unions have a lot of liquidity, you don't really need somebody to step in. But when liquidity is and credit unions aren't buying like they normally would, like today, Alloya will step in and we actually can put some of those loans on our balance sheet to help the selling credit offload those loans and feel comfortable that they can meet their liquidity and balance sheet needs. So those are just some things. Those are high level talking points.
Well, and I'm sorry, and the NCUA compliance. So I'm assuming that would deal with the third party due diligence requirements.
Correct.
And they're
so we don't go through and let anybody say, hey, Alloya is doing the due diligence.
Correct.
With you. We're not. But everything that you need to be able to do is there, right? So when you go and see a package, everything that you need is there. Now you can request more for sure, but everything that is needed to fulfill those requirements is there.
The seller is required to, it's like filling out anything line. You need to put something in these 5 buckets, and then the buyer goes and looks at that buckets, and then they make their own decisions based on their own due diligence. But you have the portal there so that they can do it. Okay.
Again, because we are a depository, and part of what corporates do, right, facilitate the flow of money from institution to institution, that all happens automatically, right? So there's no more wires, things of that nature. That's all done through our payment rails already. And so that really helps reduce some of the back end headaches. And then where we really shine is on that monthly reporting. So we do a lot of the reporting. So once the deal closes, that's the fun part of it. The not so fun part is what happens when it closes, right? It's you have to send your reports to investors. You have to send your payments to investors. All that is done automatically because of what we are. There are fintechs that do similar things, but they can't do it because they are not a depository. Now they've done a great job figuring other ways around that. But because of what we are able to have that and that happen automatically.
That's the credit union advantage, if you will.
Yeah. Yes.
Types of loans, are there any business loan, commercial, signature?
Yeah, completely agnostic. We've done some fun ones. So ATM, like ATM machine,
Right.
some of those. We've done airplane loans, done power pressure washers, done huge commercial deals. I'll say the vast majority of our stuff is vanilla. We serve credit unions, so vanilla, auto loans, mortgages, recreational, some signature loans. But we get fun and have some interesting things cross our paths. That's actually fun. I'll see something come through and I'll say, hey, send me that package. I want to look at these loans a little bit more. Just been a while since we're underwriting side of things, and fun to see what type of loans come about. So
That's great. Yeah, the pendulum swings on when credit unions do or don't have liquidity, and then even if credit unions don't have it, there's some that do, and if credit unions in totality do have it, there's some that don't. So that goes back to the matchmaker type concept. Have you, just curious, anecdotally, in some of my conversations with credit unions, I'm seeing where NCUA is saying, hey, your loan to assets are too high, your loans to share. Pick some barometer of liquidity that relates to loans. I've seen credit unions get beaten up in that regard. I'm imagining you've had people calling saying, hey, NCUA is saying my liquidity is getting a little tight, so I want to sell some loans. Are those kind of conversations happen?
here's right. So I've been in my position. I was an underwriter right when I started. So I've been here for 18 years. That's been happening forever. The super interesting thing is it's different from region to region. So certain regions will have different.
I'm shocked.
And I won't say which one of those. It does vary from my experience. This is purely my experience. It does vary, and sometimes it will vary from exam, right? But yeah, happens constant. What we have noticed more than anything is they won't say, hey, your loan to share ratio or your loan to asset ratio is getting too high. You need to sell these loans. They'll say, hey, you've got your liquidity, your loan to assets are X, and that's historically okay for you. And you've got some line of credit, and you've got your non-member deposit ability, and you're able to raise certificates of deposit or what have you. You have your outlets. But what you don't have is your ability to sell loans. We want you to get set up to be able to do so, whether that's through Alloya or Editor or what have you, or just simply have it internally set up so that you know if you need to sell. Right now, we're going through with a credit union to sell a $250,000 pool, which is, truth be told, that is so small for this credit union. It's probably not worth a lot of people's time, except for that's what they want to be able to do so that they know they're ready to sell when they can sell. And yeah, that's what I'm saying. That's so much hey, you 5% sell 5% of your loan to assets, so 5% of it to get under the threshold is more. We want you to get ready to be able to do as they're looking at another liquidity source.
Sure. Exactly.
And they might want it to start selling. I wouldn't be surprised for them to say, hey, sell it once a year, kind of like testing your line of credit.
Oh, that makes sense. Makes a lot of sense. Very good. So, Bill, is there anything that I should have asked you about this program that you want to make sure you mention, or anything else under the sun? Interesting times right now. Anything else you want to touch on other than this program? But anything on the program first, and then anything else you wanted to chat about?
I'll say this: we are super excited and proud of our platform, and we have big things for it. But it is just one thing that we do, right? And I think it's a great compliment to credit unions and the system at large, but it's not the only thing we do. Anything that credit unions are looking for liquidity, investments, capital, in general, look to your corporate. I'll just say a lawyer, look to your corporate first. A part of a corporate, understand that it can do a lot for you that you may not even know. So I'll just give a kind of a pitch to the overall corporate structure. We do a lot more than people think we can. And then two, I'm going to respectfully decline any thoughts what is going on in this hectic turbulent world right now, as I am not the expert in any way, shape, or form.
Very good.
So
Very
thanks for
good.
that.
Got it. Got it. And Bill, if someone's listening to this and they're a member of your corporate or another, and they want to chat with you about this program and maybe potentially join your corporate, what's the best way for them to reach out and chat with you about this or anything else?
It is always great. So it's Paton at on LinkedIn, and then you can shoot me an email. It's bill.paton at alloyacorp.org. So that's ALLOYACORP.org. I know it's a mouthful, but that's the best email address. And I'm not going to give out my cell phone number because I can't imagine what types of text messages I'll be getting from some people. So yeah, the LinkedIn email is great. And yeah, thanks for having me.
Got it.
Really
Yeah.
appreciate it.
This has been fun. It sounds like a great program, another tool that credit unions can have in their toolbox. I'm glad it's working so well for credit unions and Alloya. Bill, thanks so much for your time today.
All right. Tom.
You got it. And listeners, I want to thank you for listening as always. I hope you'll listen again soon. Mark Treichel signing off with flying colors.